Ladies and gentlemen, welcome back to the channel. This is an exciting video to bring you guys because we were correct, spot on this channel. And if you watched any of the last, call it 5 videos posted to this channel, you made a lot of money, okay? We have been buying the dip because of, well, a nonsensical sell-off in AI stocks. But even more specifically than that, I was speculating that CPI was going to be released because it was going to be really good, right? Trump, I don't know the guy personally, but I think I know his character enough that he wouldn't put out a bad CPI report if he didn't have to, okay? And, well, lo and behold, CPI came in much better than expected. So here in today's episode, we're going to be going over the CPI report, the China trade headlines, everything you need to know. I hope you are buckled up, locked in, and ready to go. If you want to take it a step further, though, come trade with us. Come get involved in the best trading community. Really, it's an investing community in the world. What we're really doing is going out, finding these overlooked hidden gems in AI, software, robotics, quantum, energy, and taking decisive investments in these stocks that Wall Street is overlooking. We're talking AI stocks growing at hundreds of percents a year, trading at, 3 times sales, like crazy shit we are finding. And that is where the opportunity lies in this market, where I believe you can have a massive upside profile and limited downside profile just by investing in certain stocks. I'm not a financial advisor. I'm not a financial planner. Anything can happen. Obviously, you're not guaranteed to make money, but we are up over 150% year to date. And we're not talking about day trading the SPY every minute. We're talking about buying and holding investing strategies. Pretty incredible stuff we're doing. Check that link out down below if you'd like to come join us. With that said, we have a lot to get into in today's episode, so let's get started. Okay, now in broader news today for the markets, what is causing the markets to skyrocket is the September CPI that was softer than expected. Okay, core prices rose 0.23% in September, lowering the 12-month core CPI to 3.0%. Headline prices rose 0.31%, and CPI is 3.0% over the prior 12 months. The estimates, the consensus estimates for core month over month was 0.31%. Okay. The year over year core number was expected at 3.0%. So core month over month at 0.23% is a big surprise to the downside. But it's not so weak that you get economic concerns, okay? Because a super weak number would have been like maybe questionable, like it would have caused or brought up concerns about the economy. Okay, so as far as banks are concerned, the only estimate lower was Moody's that had an estimate for core month over month at 0.22%. Every other estimate, let me rattle them off to you. Wells Fargo, UBS, TD Securities, Pantheon Macroeconomics, Nomura, Morgan Stanley, JP Morgan, Goldman Sachs, First Trust, Employ America, Deutsche Bank, Citi, Citadel Securities, BNP Paribas, BMO Capital Markets, Barclays, and Bank of America all had higher estimates. The median forecast was 0.30% month over month. We came in at 0.23%, okay? Significantly lower than the median. But certain banks, like Nomura, had an estimate at 0.35%. They missed the ball by a large margin. Morgan Stanley, 0.32%, missed the ball by a large margin. Deutsche Bank, 0.32%. Citadel Securities, 0.32%. BNP Paribas, 0.32%. BMO Capital Markets, 0.32%. Barclays, 0.36%. All of them missed the ball by just missed it by a mile, okay? Now, for year-over-year expectations for core, Moody's was the only one that was correct. Oh, First Trust was also correct at 3.0%. Everyone else was at 3.1% or 3.2%. Barclays, 0.32%. PNB Paribas, 3.2%. JP Morgan, 3.1%. Okay, Namura, again, 3.2%. Most of them were at 3.1%. That was the consensus estimate. So across the board, better than expected. Last month, we were at 3.1% year over year for core. And month over month was 0.35%. So last month was 0.35% month over month. And we just came in at 0.23% month over month. That's quite a large move lower in just a month. Okay, guys, I said it on this channel many times, many times. I don't think I could have been more clear on this. Okay, we were going to get a better than expected CPI report today. One of the last videos, you know, like all of the prior videos posted to this channel, all said the same thing. Trump was not going to put out a bad CPI report. They did not have to put out a CPI report today. They chose to because it was going to be a good report. Okay? That was part of the whole bullish premise for this week. I wanted to be in stocks. I wanted to be buying the dip because CPI was going to come in strong. Okay? Now, what's interesting and what I heard a lot of talk about yesterday was that Wall Street is actually nervous about big tech earnings more than anything else. Okay? Interesting. I can't find the specific VIX, but there's a VIX that measures single stock volatility. Let me find it. Okay, so like I thought, it is the VIX EQ, the VIX equal weight. Now, I couldn't actually find this on any of the charts. It just doesn't come up because it's brand new, which makes sense, okay? So you actually have to go to Google to pull this up. And I don't know why it just won't even like let me type on Webull right now. So that's cool. Don't understand what's going on there. Okay. Awesome. Just won't let me type. I don't know what the hell's going on with Webull right now. But if you look at Google, good old Google, okay, you can see the VIX EQ. Okay. This is single stock volatility. So this is a VIX, not like the normal VIX, which basically measures the volatility, the difference between calls and puts being bought on the S&P index. Okay, that's what the VIX is for 30 days out. Okay, so the VIX recently spiked. It's come down a bit. But when you look at the equal weight VIX, that is basically showing you single stock volatility, that is still very elevated. By comparison, the single stock, this VIX EQ, hit a high of 70 on April 8th. The VIX hit a high of 52 on April 8th. Okay. The VIX today is at 16.64. Okay. The VIX EQ is still at 40. So apples to apples, the spread between the two is at a level we've never seen before. Okay. What does that mean in English? Like, what is that telling us? That actually suggests that people are not that nervous about the headline S&P, but on a single stock basis, there is a lot of volatility. Okay. This is something we have known for a while now, like with single stocks the last couple of weeks that have been, selling off, right? The index has not been selling off, but even deeper than that, it suggests that next week markets are concerned about big tech earnings. It suggests that maybe this sell-off has been what I've heard, commentators on CNBC talk about, is Wall Street is just nervous about single stocks like Apple, Microsoft, Google, Nvidia for their earnings. They're not as worried about the broader markets, but they've potentially been selling stocks recently, like AI stocks, because of potential for bad news on mega cap earnings. Okay, so maybe it wasn't the government shutdown that was causing the fear and selling in markets. Maybe it has not been the trade tensions with China, but maybe it's nervousness around capex for AI at the hyperscalers. That's what a lot of people have been talking about now on CNBC, which could make some sense, but honestly, that sounds ridiculous because you shouldn't be worried about AI spending at the hyperscalers. That spending is going to continue for a long time. Now, today is especially interesting that it's so bullish, even though Trump eliminates all trade talks with Canada over a Reagan TV ad. Trump said he was doing so because of an allegedly fake advertisement that Canada was airing that features former President Ronald Reagan speaking negatively about tariffs. Ontario Premier Doug Ford, whose province launched the ad campaign, wrote after Trump's announcement, quote, President Ronald Reagan knew that we are stronger together. So trying to, suggest that the US and Canada should work together, which obviously I think we should. Ford recently said Ontario would spend $75 million on ads to run in the United States featuring Reagan criticizing tariffs. So yeah, despite US-Canada trade talks reportedly ending, the markets don't seem to care at all. There is basically no reaction from that. Today is really all about CPI. China holds security talks with the US as its vice foreign minister meets a US delegation in China. Colombia dialogue with the US on tariffs is quote unquote fluid, said the ambassador. And Russia today vows a strong response to EU sanctions. Japan's trade minister spoke by phone with US Commerce Secretary Lutnick today. Wells Fargo says today that they expect a 25 basis point Fed rate cut on October 29th. JP Morgan said yesterday that they are expecting the Fed to stop quantitative tightening, that is the practice of selling assets on the open market, reducing the size of their balance sheet next week. That could be really positive news for stocks. Mexican President Sheinbaum says, quote, we're going to wait, when asked about U.S. decision to terminate trade talks with Canada. BlackRock CEO Larry Fink has said AI is not a bubble, but there will be failures. This is capital that is mostly well spent. And that's obvious, especially in the venture capital world. There's going to be some companies that do not make it, right? If you are a venture capitalist and you're investing in 100 startups, probably 90 of them are going to fail. But the 10 that are successful are going to be wildly successful. And that makes up for the 90 that failed. Now, the odds of 3 rate cuts in 2025 reach an all-time high of 85% following the data out today on CPI. Now, as far as the Fed rate monitor tool, this is something you guys can look at every day to monitor where the markets are pricing Fed policy. For October 29th, there's a 98.5% chance of a Fed rate cut, okay, on October 29th, okay? 1.5% chance of no cut, so it's basically a certainty. Now, you're looking at a 97% chance of another Fed rate cut, okay? For January 26th, there's a 57.8% chance of another rate cut, okay? So you're pricing in 3 rate cuts over the next 3 Fed meetings. For March, there's a 28% chance of another rate cut, but a 49.7% chance of a pause. So you're pricing in a cut October, December, January, and then pricing in a pause for March. White House senior advisor Hassett, when asked if the China trade deal comes by November 1st, says, quote unquote, we'll see. Hassett says that inflation numbers were fantastic. Hassett says that there has been some thawing in recent days with China, so suggesting that tensions are getting better around trade, not worse. Hassett says we're frustrated with some Chinese actions, and he says that Trump and Xi are great friends. White House senior advisor Hassett says the shutdown could drop GDP by 0.1% each week. And he says there is no evidence that tariffs are causing inflation. Canada's Prime Minister Carney says Canadian officials have been working on negotiations on trade. A lot of progress has been made, and we stand ready to pick up on progress when the U.S. is ready. And White House senior advisor Hassett says that he expects further inflation reductions in future reports. Now, we did have other data that came out today. S&P Global Composite PMI came in at 54.8. The estimate was 54, and last month was 53.9, so that was better than expected. Manufacturing PMIs came in at 52.2. Last month was 52.0, and the expectation was 52, so that was better than expected. And global services PMIs came in at 55.2 versus 54.2 last month, and the expectation of 53.5. So all of these S&P PMIs came in better than expected. Now, Michigan consumer sentiment came in at 53.6 on the headline. Last month was 55.1, and the expectation was 55. So that came in worse than expected. 5-year inflation expectations came in at 3.9% versus last month at 3.7%. Consumer expectations came in at 50.3 versus last month at 51.7. Current conditions came in at 58.6. versus last month at 60.4. And 1-year inflation expectations actually came down to 4.6% from 4.7% last month. But I'll tell you, the Michigan Consumer Sentiment Survey is very flawed, and it's only like 200 respondents that are like 70% Democrat. So I don't know how much Wall Street cares about these numbers at this point. Today was really about CPI, trade talks sounding like they're getting better with China, and that was that. Even the trade fallout with Canada largely was ignored today. But the big catalyst next week is going to be the Fed and big tech earnings. Like, next week is going to be absolutely wild. So let me know your thoughts on all of this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Check that link out down below in the description of this video if you want to come invest in these under the radar AI software, biopharmas, quantum, robotics companies alongside us. Ideally, we are not trying to chase the stocks that everyone already loves and knows about. We want to find the next big winner before Wall Street does. And that is what we have been doing. And that is how we are able to outperform the S&P by like 15x this year. Okay. And I believe if we were a hedge fund or institution, we are the best performing hedge fund or institution this year. Not 100% sure on that, but we are up like 150% year to date. And I don't know if any person on Wall Street, any firm on Wall Street that is even coming close to that. So yeah, check it out. Link down below if you guys would like to. Also, sign up with Public. Deposit $1,000 and get $100 in your choice of free stock. That's literally free money. If you guys would like, that link is down below. Public is my favorite brokerage by far. Have a great rest of your day, and I will see you in the next one. But again, next week is going to be a huge week with the Fed, with, AI earnings in focus from the hyperscalers. Specifically, is the CapEx going to continue? And for anyone that's a little nervous over that, there's no choice. It has to continue, okay? I don't see anyone on Wall Street explaining it like this, but when you hear it like this, hopefully it makes some sense. CapEx is not going to slow down or stop from your AI hyperscalers. Why? Because they're all in a fierce competition right now. Google is fighting for its relevance. It's being attacked at all angles. If Google slows down their CapEx spending and gives the ball to OpenAI or the next guy, Google may not be around in 10 years. Okay? Google cannot not spend on AI. Microsoft, they cannot not spend on AI. They have CoreWeave. They have players like Nebius and Applied Digital and Oracle that are coming in to steal their business with data centers and AI inference. Okay. You can make the same examples for all of them, really. Okay. They're all fiercely competing with each other. And until there is like a dagger in the AI coffin to stop the spending, it's not going to stop. And as we showed earlier, the single stock volatility index, the VIX EQ, which I can only pull it up on Google, it's still at very high levels, which shows that Wall Street is nervous around earnings next week. See, 20% of the S&P has already reported earnings, so you still have the majority of the S&P market cap waiting to report. Most of that is going to happen in this next upcoming week. 84% of stocks are beating. That is one of the best beat ratios we have ever seen in the history of the stock market. Okay. Yeah, I have no reason to think that's going to change next week. Now, we also have the Fed and what could be the end of quantitative tightening. Okay. Hence why I said in one of the last videos, AI stocks are about to go crazy. We've seen AI stocks go a little crazy today. And I think right now we're actually getting into gear. We're accelerating on the highway, if you will, to get to the speed limit, aka the end of the year rally. I think we're actually gearing up for that right now. And I think it's going to start and really kick into full steam ahead following next week's earnings and another Fed cut. So again, not a financial advisor, not a financial planner. Come trade with us, come invest with us. Again, it's mostly buying and holding in, stocks, but sometimes every now and again, if there is an opportunity that has a very high, chance of success, that I do like to trade short-term stuff as well. Momentum stocks, all of that. But what we're really doing is trying to hit those 10, 20, 30x upside winners while limiting the downside risk profile in these core themes that are going to be bull markets for the next 10 years. Again, energy related to AI software, robotics, quantum, gene editing, biopharmas. These are not going to calm down for 10 years, right? We want to be in these areas. And we want to be in the right stocks in these areas. And that is what we are doing. So yeah, check it out, link down below. But with that said, that is it. Have a great rest of your day. And I will see you in the next one.